So, imagine you were cleaning out an attic,
Oh boy, the classic scenario.
right? Or maybe it's like an estate sale you just wandered into, or you're sorting through a grandparent's belongings. And you move a stack of old books, and underneath you find this really heavy, like leather-bound album.
I can already smell the dusty paper.
Exactly. It has that distinct smell of aged paper and history. You crack it open, and inside there are just thousands of tiny, colorful pieces of paper with those little perforated edges. Stamps.
Pages and pages of them.
Yeah, meticulously melted. And looking at this album, a very specific, kind of thrilling question immediately pops into your head. And it's for you, the listener, right? Are you holding a fortune or just a pile of nostalgic, fundamentally worthless paper?
And spoiler alert, it's usually the latter. But, we'll get into that.
We absolutely will. Today, we are decoding the brutal financial realities behind what has historically been called the hobby of kings. This is a deep dive designed specifically for you, the learner. We are plunging into a massive stack of sources today.
Oh yeah, we have a ton of material to cover.
We really do.
Yeah.
We're looking at massive global e-commerce catalogs like Nordstrom, which lists tens of thousands of items. We're looking at the highly speculative digital and crypto stamp blogs. And, most importantly, we've got these really rigorous financial research reports analyzing alternative wealth assets.
Right, the heavy-hitting financial data.
Exactly. So the mission here is to teach novice collectors how to, separate common paper from strategic investment assets. We're going to compare stamps to your traditional investments like stocks and bonds. And we really want to determine the ideal risk profile for someone looking to use Philately as a long-term safe haven.
Because it's not just tweezers and magnifying glasses anymore.
No, definitely not. We are talking about million-dollar auctions, major financial scandals, and this wild collision of physical paper with blockchain technology.
It gets surprisingly intense. I mean, the necessity of decoding this market becomes super apparent when you just look at the sheer volume of material in existence.
Right. Where does it even start?
Well, it really kicks off in Great Britain. They issued the first adhesive postage stamp, the 1 penny black, in 1840.
1840. Wow.
Yeah, and it was a massive move. It totally revolutionized global communication because before that, the person receiving the letter had to pay for the postage.
Oh, really? I didn't actually know that.
Yeah, so shifting the cost to the sender was a game changer. And since then, I mean, literally billions of stamps have been printed. Just looking at that Nordstrom catalog we reviewed, they list over 16,000 discrete articles just currently sitting in their inventory.
That's just one catalog.
Exactly. You can acquire stamps from nations that don't even exist anymore.
Like what?
Oh, like the German Democratic Republic, Czechoslovakia, places like that. Or you have these highly thematic issues covering everything from, I don't know, prehistoric fauna to the royal baby.
Right.
And
Right.
so the sheer scale of the market creates this massive informational asymmetry. And that asymmetry is exactly what traps novice collectors or, individuals who inherit a collection.
Okay, let's unpack this right here. Because the core issue we need to dismantle right out of the gate is what the financial researchers label the inheritance myth.
Yes, this is so important.
Because we all have this hardwired cognitive bias when it comes to antiques, right? We think, oh, this object is old, therefore this object must be valuable.
It's natural to think that.
It is. But looking at the data, age is perhaps the absolute worst standalone metric for evaluating philatelic value.
It's a critical error. The financial reports are completely explicit about this. The vast majority of inherited family albums are, those shoeboxes full of loose stamps.
We've all seen the shoebox.
Right. They hold near zero commercial value. And that's regardless of whether they date back to the 1920s or the 1890s.
Wait, even the 1890s, that's over a century old.
Doesn't matter. The printing presses of the early 20th century were highly, highly efficient. A standard definitive stamp from, say, 1920 might have had a print run in the hundreds of millions.
Wow. Millions.
Millions. Furthermore, these inheritance collections are almost always poorly conserved.
What do you mean by poorly conserved? Like water damage?
Water damage, sure, but even just basic handling. They were touched with the natural oils of bare hands. They were exposed to fluctuating humidity up in those attics you mentioned. Or, honestly, worst of all, they were glued directly onto the album pages instead of being properly mounted with hinges or archival mounts.
Oh, so the glue just ruins the paper.
Completely destroys the financial premium. From a strictly financial standpoint, common, mass-produced, or improperly conserved stamps just have zero investment utility.
So just to give a really clear picture to the listener, let's compare this to the classic car market.
Okay, I like this analogy.
Right, so imagine a standard, mass-produced 1980s sedan. It's been sitting in a humid driveway for 40 years. That is not a classic car. It's scrap metal.
Right, it's just old.
Exactly. The fact that it survived 4 decades doesn't magically imbue it with some aggressive valuation, and the same applies to a piece of paper. But if you have a 1980 supercar, and it had a production run of maybe 50, and it's been kept in a climate-controlled vault with delivery mileage,
Now you have an investable asset.
boom, investable asset. So my question for you is, how exactly does a novice make the jump from casual hobbyist to strategic investor? Like, what is the exact framework for identifying the philately version of that supercar?
Well, the research provides a very rigid, non-negotiable framework. To actually cross that threshold from a hobbyist collectible to a recognized safe haven asset, a stamp has to stand on 4 distinct pillars.
4 pillars, okay.
And this is crucial. The absence of even one of these pillars immediately disqualifies the asset from serious capital allocation.
So it's an all-or-nothing game.
Absolutely. So the first pillar is real rarity.
Real rarity, as opposed to fake rarity.
Well, essentially, yes. It's fundamentally different from artificial scarcity. Like, you know how a modern postal service might issue a limited run of 50,000 units today just to sell to collectors?
Oh yeah, the manufactured collectibles.
Right. That's artificial. Real rarity refers to extreme historical scarcity. We're talking about situations where only a minuscule fraction of the original print run survived, or the stamp was an anomaly to begin with.
Anomalies like printing errors or provisional issues printed during wartime blockade.
Exactly. Or stamps from colonies that existed for maybe a fraction of a year before being wiped off the map by a conflict.
Oh wow, so the history is literally baked into the rarity.
Precisely. You can't go back to the 19th century and manufacture more authentic postal history. The supply curve is permanently capped, and honestly, in many cases, it actively shrinks.
Shrinks because they get destroyed.
Yeah, physical pieces are lost to fires, floods, or just poor handling over the centuries. So that capped supply is the foundation, but it immediately runs into the second pillar, which is condition.
Ah, condition. You mentioned the bare hands and the glue earlier.
Yes, and this is where the market is ruthlessly unforgiving. I mean, we were talking about the physical state of a tiny, fragile piece of paper. Even microscopic defects can trigger a catastrophic loss in premium value.
Microscopic, like literally needing a magnifying glass.
Oh, absolutely. Investors and grading committees are scrutinizing things you wouldn't even think of. They look at the exact centering of the engraved image within the perforated borders.
Wait, so if the picture is just slightly printed too far to the left, it loses value?
A massive amount of value. They're also checking for vibrant, unfaded pigmentation. They are examining the integrity of the gum on the reverse side of the stamp.
The gum, like the glue you lick.
Yes, the original adhesive. If it's been hinged or disturbed, the value plummets. A microscopic tear, a thin spot in the paper fibers, or a heavy disfiguring cancellation mark from a post office, any of that can strip an otherwise rare stamp of its investment grade status.
You know, the terminology used to describe that condition seems actively hostile to the novice. I was reviewing the risk disclosures in these financial reports, and they specifically warn against the grading nomenclature.
Oh, the naming conventions are a minefield.
Yeah. A novice might see a stamp graded as fine and assume, hey, this is a solid, secure asset, it's fine. But in reality, purchasing a fine stamp is essentially buying fundamentally flawed debt.
The linguistic trap is severe. In the established philatelic grading hierarchy, fine is actually quite low on the spectrum.
Which makes no sense to a normal person.
I know. The scale typically descends from superb to extremely fine to very fine to very good to good and finally average.
Wait, so fine is 4th down the list.
Exactly. So when an expert committee grades a piece as fine, it actually signifies noticeable aesthetic or structural flaws. Perhaps the design is heavily off-center, like it's literally touching the perforations, or the color has noticeably oxidized.
That's incredible. So fine actually means visibly flawed.
Yes. Buying a fine-grade piece is analogous to buying a junk bond. It might have a place in a highly speculative, high-yield portfolio if you're trying to do some arbitrage, but it is absolutely not a safe haven asset. The research really emphasizes that participating in this market without a deep understanding of these grading nuances is the primary way new capital is destroyed.
Which feeds directly into the third pillar, certified authenticity. I mean, if microscopic differences in centering or paper thickness dictate thousands of dollars in valuation swings, the incentive for forgery has to be astronomical.
Oh, it's a massive industry.
Our sources detail instances where forgers don't just print fake stamps from scratch, they actually alter genuine common stamps to mimic rare variants.
Yeah, that's the really insidious part.
Like, they might take a common issue and chemically treat it to alter the color,
Right.
or re-perforate the edges to match a highly sought-after limited-run variant.
Exactly. The technological arms race between forgers and authenticators is intense. Forgers will literally source blank, period-accurate paper from the 1850s to bypass basic age tests.
That is terrifying for an investor.
It is. Consequently, the third pillar requires that any investment-grade stamp must carry an active certificate of authenticity from a recognized, independent philatelic expert committee.
So you can't just trust the guy selling it to you.
Never. These committees utilize modern forensics. We're talking spectrometry, high-resolution microscopic analysis of paper fibers, ink composition analysis, all to verify provenance and physical integrity.
So it's basically CSI for stamps.
Pretty much. And without that certificate, the liquidity of the asset drops to zero. Serious wealth managers and auction houses simply will not touch uncertified material.
Okay, so we have cap supply, pristine condition, and forensic authentication.
Right.
But none of those matter if nobody wants to buy the paper. And that brings us to the fourth pillar, international demand.
The final piece of the puzzle.
The analysts at Stamp Auction Network highlight a really fascinating macroeconomic trend here. A perfectly preserved, extremely rare stamp from a tiny, obscure island nation just doesn't command the same investment premium as a moderately rare stamp from Great Britain, the United States, or China.
Yeah, the asset's value is chained directly to the GDP and the cultural footprint of its origin nation.
Which is wild. Why is that?
It's a direct reflection of global wealth distribution and cultural repatriation. So Great Britain holds deep historical prestige as the inventor of the postage stamp, right?
With a penny black.
And then the United States and China possess massive, affluent, middle, and upper classes. As wealth expands in a nation, there is a predictable secondary effect. The newly affluent seek to reclaim their national heritage and history.
Ah, so it's a status symbol.
Completely. Collecting elite philately becomes a mechanism for wealth preservation that also signals cultural sophistication. So when a rare piece of early Chinese postal history comes to auction, you have multiple high-net-worth individuals competing fiercely to bring that asset back to their portfolio.
And that competition drives the price up.
Exactly. That competitive friction is what drives and sustains the pricing floor. A rare stamp from an obscure, forgotten territory might be academically fascinating, but if only 5 specialists in the entire world collect that territory, the market lacks the liquidity and competitive depth required to function as an investment.
That makes total sense. Okay, let's pivot slightly because I really want to challenge the actual financial viability of this entire construct.
Let's do it.
We keep using terms like investment grade and safe haven. But if I'm managing a family office or even just my own retirement portfolio, I have access to S&P 500 index funds, I have treasury yields, real estate investment trusts. What is the empirical data actually telling us about the returns of these 4 pillars?
Well, the data provides a very clear, century-long perspective. The sources highlight this super comprehensive academic study that focused specifically on British investment-grade stamps between 1900 and 2008.
Okay, so a 108-year horizon. That's a massive sample size.
Very robust. They track the price appreciation of elite pieces over that entire period, the result, an annualized nominal return of 7.0%.
7.0% nominal. Okay, let's be real. When we discount for inflation over the 20th century, the real purchasing power gain sits at roughly 2.9% annually.
Right, it drops significantly.
That is a massive haircut. Historically, a 2.9% real return beats sitting in fixed income government bonds over that specific century. But it significantly lags behind the broad equities market.
It does lag equities, yes.
Furthermore, the data indicates the volatility, like the standard deviation of those price swings is actually quite comparable to equities. So my question is, why would any sophisticated investor take on equity-level volatility for bond-level real returns, especially when dealing with a physical asset that's hard to sell?
If we connect this to the bigger picture, the primary utility here isn't yield maximization.
It's not about getting rich quick.
No, it's about portfolio descorrelation.
Okay, unpack that term for the listener. Descorrelation.
Basically, the beta of elite philately relative to the broader financial markets is near zero, meaning they don't move in the same direction at the same time.
Ah, I see.
Think about it. When the dot-com bubble burst, or when the 2008 financial crisis triggered a catastrophic liquidation across equities and real estate, the value of a verified 1840 penny black remained completely insulated.
Because stamps don't care about the mortgage crisis.
Exactly. A rare 19th century stamp does not derive its valuation from corporate earnings reports or the Federal Reserve's interest rate adjustments or global supply chain bottlenecks. Its value is derived entirely from historical scarcity and targeted collector demand.
That is so interesting.
High net worth individuals utilize these assets precisely because they do not move in tandem with the global financial machine. It is a defensive strategy. It is not an offensive growth play.
Here's where it gets really interesting to me. The physical nature of the asset introduces a profound advantage in wealth concentration, but it also introduces some terrifying vulnerabilities.
Oh, absolutely.
Like, if you want to move $10 million of real estate across a border, you literally can't. It's land. If you want to discreetly transport $10 million in gold bars, the sheer weight and logistics make it nearly impossible.
You'd need an armored truck.
Right. But $10 million in elite philately can fit inside a single lightweight album in a carry-on briefcase. You can literally walk onto a plane with it. It is the ultimate portable wealth.
It really is.
However, on the flip side, if I hold a $2 million paper stamp, a simple house fire, a spilled cup of coffee, or a minor fluctuation in vault, humidity wipes out my entire portfolio.
A very expensive cup of coffee.
Exactly. That physical vulnerability has to be pushing capital away, or at least heavily taxing the investor through specialized insurance premiums, right?
The carry costs are indeed a factor, primarily insurance and secure climate-controlled storage. But the market's response to that physical vulnerability and the volatility at the very top of the market requires careful analysis. The physical fragility is actually part of what maintains the rarity.
Oh, so because they get destroyed, the ones that survive become more valuable.
Precisely. However, the pricing at the ultra-high end is subject to immense psychological factors. Consider the famous U.S. error stamp, the inverted Jenny from 1918.
Oh, I've seen pictures of this. Is the airplane printed upside down?
That's the one. Only one sheet of 100 stamps was sold, featuring the Curtiss JN-4 airplane printed upside down. And because it is backed by the massive U.S. collector market, going back to our international demand pillar, it commands a massive premium. In 2023, a single exemplary copy sold for a record-breaking $2 million.
$2 million for one stamp.
Yes. That represents the absolute peak functioning of the four pillars. But, and this is a big but, the top of the market is not a guaranteed upward trajectory.
Which brings us to the British Guiana 1 cent black on magenta. This is the perfect case study for the winner's curse in this space.
It's a painful case study.
It is. So for the listener, this is a unique piece, literally the only known surviving copy in the world.
The Holy Grail.
Right. And in 2014, it went to auction at Sotheby's and sold for an astronomical $9.48 million.
Unbelievable amount of money.
But then, when it was brought back to the market in 2021, it only sold for $8.3 million. That is a drop of over $1 million on a singular, globally recognized asset. I mean, that entirely shatters the illusion that holding a one-of-a-kind asset guarantees a profit.
The 2014 versus 2021 sales perfectly illustrate the liquidity and macroeconomic risks inherent in alternative assets. Look at the context. In 2014, you had 2 or 3 billionaires actively competing in the room for the prestige of owning the world's rarest stamp.
Right. Egos clashing.
Exactly. They drove the price far beyond intrinsic valuations. By 2021, the macroeconomic environment had shifted, the collector demographics at the absolute highest echelon had adjusted, and that same fierce competitive friction was absent.
So there was basically nobody to bid against the buyer.
Exactly. So the seller absorbed a massive loss. This demonstrates that even the most famous stamp in existence is subject to the mood of the buyers on the specific day of the auction. The illiquidity of the asset means you cannot simply set a limit order and wait like you can with a stock. You are entirely at the mercy of the auction room's psychology.
And the auction room extracts its own pound of flesh, too. We can't ignore the friction costs here.
The fees are brutal.
If you buy a stock today on your phone, the transaction fee is effectively zero. But if you can sign $1 million stamp to a major auction house, The buyer is paying a 20% to 25% buyer's premium on top of the hammer price. And you, the seller, might be paying a 10% commission.
That's a huge spread.
It's a massive spread.
Sure.
That means the asset has to appreciate by roughly 30% just for you to break even. That fundamentally alters the math on that 7.0% nominal return we talked about earlier.
Absolutely. The frictional costs of buying and selling physical collectibles through specialized auction houses severely degrade short-term yield. This is precisely why the financial research mandates a minimum hold time of 5 to 10 years.
You literally need a decade.
You need a decade of compounded appreciation just to clear the auction house commissions and break even in real terms.
You know, that reality makes the systemic risks we see in the Spanish market even more devastating.
The funds.
Yes, the funds. Because when everyday investors realize the math is incredibly difficult to beat on their own, they turn to institutional funds. And our sources explicitly detail the catastrophic fallout of the Afinsa and Forum Philatelico scandals.
Those were dark days for the market.
For our listeners who aren't familiar, these were massive financial entities operating in Spain that fundamentally mutated the traditional philatelic investment model into a massive shadow banking operation.
It was a disaster. The mechanics of the Afinsa and Forum Philatelico collapse offer an absolute masterclass in regulatory failure and the dangers of opaque alternative asset structures.
How did they actually work?
Well, these companies did not operate like a traditional dealer, where you, the investor, purchase a verified stamp, hold it, and take physical possession of it.
Right, the portable wealth idea.
Exactly, they abandoned that.
Yeah.
Instead, they sold shares or participations in a broader portfolio of stamps that were held in their own corporate vaults.
Red flag number one.
Big red flag. They offered investors guaranteed fixed high-yield returns, and they heavily marketed these participations as risk-free safe havens, claiming they were backed by the supposedly continuous, never-ending appreciation of the underlying physical assets.
Does the Forum Philatelico scandal prove stamps are a bad investment, or does it just prove that handing your money to an opaque, unregulated fund is a bad idea, regardless of the asset?
It's 100% the latter. It effectively operated as a Ponzi scheme draped in the legitimacy of the hobby of kings.
Because the investors didn't control the physical assets.
Right. They couldn't verify the condition, they couldn't verify the rarity or the actual market demand. They were relying entirely on internal valuation models generated by the very companies selling the asset.
Which is a massive conflict of interest.
It's insane. The companies would buy massive quantities of common low-grade stamps, literally the exact type of material that violates the 4 pillars we discussed earlier.
The shoebox stamps.
Yes. They'd buy the junk, artificially inflate their book value, and use the incoming capital from new investors to pay the guaranteed yields to the early investors.
The classic Ponzi structure. So what happened when it blew up?
When European regulators and the Spanish authorities finally intervened, the entire structure imploded. Hundreds of thousands of retail investors lost the vast majority of their life savings.
That is heartbreaking.
It really is. And they lost it because the underlying collateral, the stamps in the vaults, were essentially worthless on the open international market. But the crucial takeaway from the financial analysis of this event is that the scandal does not invalidate elite philately as an asset class.
Right. The 7% historical return is still real.
The historical 7% return of verified investment-grade material remains empirically true. What the scandal invalidates is the delegation of control. The golden rule established by these systemic failures is absolute. If you allocate capital to this space, you must possess the specialized knowledge to select individual pieces, verify their certificates, and take physical delivery of the asset.
But taking physical delivery brings us right back to the vulnerability of paper. How do modern investors reconcile the need to physically control the asset with the risk of holding a flammable piece of paper?
Well, this is where things get really sci-fi.
It does. The sources introduce a radical shift in the market structure that attempts to bypass this entirely. The traditional, centuries-old market of paper and ink is violently colliding with the wildest market of the 21st century.
Crypto, blockchain technology, and digital provenance. It's a profound philosophical pivot.
Our sources tracking the digital frontier, like crypto stamps, TOP, highlight how national postal services are experimenting with this right now. Deutsche Post recently launched the crypto stamp Brandenburg Gate.
Yes, merging the physical with the digital.
They directly link a physical stamp issue with a digital token residing on a blockchain. The paradox here is just staggering to me.
So.
Well, the entire value proposition of a 19th century penny black is rooted in physical survival.
Right.
It is valuable because the physical paper outlasted wars, fires, and the sheer degradation of time. But NFTs attempt to artificially create scarcity in the digital realm. A digital token is mathematically rare because the code mandates it, not because it survived a century of physical attrition.
It's a completely different kind of scarcity.
It is. I just laugh at the juxtaposition of a 19th century penny black sitting next to a digital NFT token on a smartphone. Imagine explaining this to a Victorian-era postmaster.
They'd lock you up in an asylum.
They really would. And honestly, the digital space is proving to be incredibly unstable. Starbucks recently shuttered its massive NFT Odyssey beta program, and the broader NFT market has seen catastrophic collapses in valuation.
It's been a bloodbath.
So my question is the integration of blockchain into Philately merely a desperate attempt to capture speculative tech capital, or is there a fundamental structural problem it actually solves?
That's the million-dollar question. And while the speculative frenzy surrounding digital-only NFT art has largely collapsed, the underlying blockchain technology offers a highly elegant solution to the third pillar of Philately.
Certified authenticity.
Exactly. The traditional method relies on physical paper certificates issued by expert committees. And as we discussed, those certificates themselves can be forged or simply separated from the stamp.
Right, someone loses the paperwork.
It happens all the time. But a blockchain is an immutable, decentralized digital ledger. So imagine if a multi-million-dollar physical stamp is paired with a digital twin, a token that securely records the asset's entire provenance, every transaction history, and verified spectrographic analysis from the expert committees.
Oh, wow. So you have a permanent, unhackable record.
Yes, you create an unforgeable chain of custody. It dramatically reduces the friction of authentication. The digital token doesn't replace the physical asset. It serves as its absolute cryptographic proof of legitimacy.
So the technology transitions from being a speculative asset itself to becoming the ultimate infrastructure for verifying the physical asset.
Precisely. It's utility over speculation.
That is a massive paradigm shift for auction houses and wealth managers.
Yeah.
Okay, so we now have a complete panoramic view of this ecosystem.
We've covered a lot of ground.
We really have. We have the slow, methodical physical market of 19th century paper requiring intense forensic expertise. We have the underlying threat of liquidity crunches and massive auction friction. We have the historical data showing a 2.9% real return, acting as a beta-zero hedge against equities. And we have the integration of cryptographic provenance.
It's a complex landscape.
So, synthesizing all of this data, exactly who should be investing in this space? How do we define the exact risk profile and operational strategy for an investor entering this market today?
Well, this raises an important question about the kind of money you're using. The deep dive synthesizes all the data to build the ideal investor profile for you, the listener, and the key trait: patient capital.
Patient capital, meaning money you don't need tomorrow.
Exactly. This market is exceptionally hostile to anyone seeking short-term liquidity or rapid capital appreciation. The barrier to entry for genuine investment-grade material pieces that definitively meet all four pillars typically begins between $2,000 and $10,000 per individual item.
Per stamp. That's a high floor.
It is. And to construct a properly diversified philately portfolio that mitigates the risk of a single asset depreciating, an investor is looking at a significant initial capital allocation.
Once that capital is deployed, it is locked. Like, if you suffer a margin call in your primary equity portfolio or you require immediate cash flow for a real estate transaction, you cannot liquidate a $50,000 classic British stamp over the weekend.
You cannot click a button and sell it like Apple stock. The timeline for liquidation is a defining constraint. To achieve fair market value, the asset must be consigned to a specialized international auction house.
And they take their time.
Oh, yeah. You are subject to their catalog publication schedules and their specific auction dates. Once the hammer finally falls, you must wait for the settlement period before the funds, minus those hefty commissions we talked about, are dispersed.
How long does that actually take?
The financial reports explicitly warn that this cycle can take anywhere from 6 to 12 months.
Up to a year just to get your cash.
Yes. Therefore, the ideal investor is someone utilizing Philately strictly for wealth preservation and descorrelation. You have to be someone who has specialized knowledge and who absolutely does not need to liquidate the asset for at least 5 to 10 years.
So what does this all mean? The strategy is ruthlessly selective.
Extremely selective.
It is vastly superior to own a single forensically verified, extremely rare $10,000 item from a nation with massive macroeconomic growth than to own 10,000 common stamps worth $1 each.
Quality over quantity every single time.
The investor must aggressively avoid modern mass issues, reject anything with a fine or lower grade, and demand independent cryptographic or physical certification for every single acquisition. It is a fortress strategy, not a growth strategy.
That is the ultimate distillation of the data. Philately is not a universal safe haven for everyone. It is a selective safe haven for the informed, patient collector. When approached with rigorous discipline, deep historical knowledge, and an understanding of the frictional costs, elite Philately functions as a highly resilient mechanism for insulating wealth from traditional financial volatility.
But it requires an active defensive posture against the myths of the market.
You can't just blindly buy paper.
Exactly. Well, we have navigated the complete architecture of the hobby of kings today. We dismantled the inheritance myth that traps novices into thinking age equates to value. We forensically examined the 4 pillars of rarity, condition, authenticity, and demand.
We ran the math.
We ran the math on the historical 7% nominal returns and the brutal reality of auction house friction. We dissected the regulatory failure of shadow banking schemes like Afinsa, and we explored how blockchain ledgers are attempting to permanently solve the crisis of physical authentication.
It's been a fascinating deep dive.
It really has. But as we step back from the mechanics and the margins, I want to leave you, the listener, with a final macro-philosophical question regarding the underlying asset itself. Something to chew on.
Okay, let's hear it.
We are accelerating into a purely digital, frictionless age of communication. The act of placing a physical stamp on a physical envelope is rapidly becoming a localized historical anomaly. Future generations of wealth managers and ultra-high net worth collectors will have grown up without ever having utilized the postal system.
That's true. The physical connection is dying.
So, as that foundational day-to-day cultural connection completely severs, will the history and cultural connection to stamps eventually die out with older generations, crashing the demand and causing the entire alternative market's foundation to crumble?
A sobering thought?
Or will the total obsolescence and disappearance of physical mail achieve the exact opposite effect?
Right.
Will it transform these tiny, fragile squares of paper into magical, mythical artifacts of a bygone analog era, driving their historical premium and their valuation to heights the market has never even modeled?
Does technological obsolescence breed market irrelevance, or does it breed ultimate reverence?
Exactly. Keep digging into the data, keep learning, and keep challenging the consensus on where value actually lives. And hey, the next time you find yourself at an estate sale staring at a dusty, leather-bound album, maybe go take a much closer look at that old box of stamps in the attic. Look very, very closely at the centering.
And check the gum.
And check the gum. Thanks for joining us on this deep dive. Until next time.